Well, our next guest has spent 4 decades running his own fund. Now with $41 billion under management, Chuck Royce is the president of Royce Associates and also the co-chief investment officer of the Royce Funds. He's known as a legendary small cap investor and says he's modestly bullish and cautiously optimistic, kind of towing the fence there. Chuck, great to have you with us.
Thank you.
I wanted to ask you first about Warren Buffett's move yesterday, from one legendary investor to another. I mean, the interpretation is that he bought back his own shares because he believes that the market is going to rally from here on out. Why else would he buy his shares? What do you think?
Well, I think it's two things. He could certainly think the market's going up, but I think probably more importantly, he thinks that his stock is undervalued, and his opportunity set is limited in terms of what he can acquire at a reasonable price.
Okay.
So I think it's a sort of a double-edged comment.
Okay.
It's a good question. I mean, when a company goes out and buys back a lot of stock, do you, the investor, see that as a good thing or a bad thing, generally speaking?
You know, I think some companies have overdone it. Some companies just buy their stock back no matter what price. And I think that actually creates more capital allocation problems than it solves. So I think it depends. Price is everything.
Well, when it comes to valuations, though, a lot of investors look at small caps maybe differently than they look at mid caps and large cap companies like Berkshire Hathaway. As a small cap investor, one who knows the market so well, are the metrics different? Do you pick small cap stocks differently than you do, say, for the IBMs and the Berkshire Hathaways of the world?
Theoretically, no, but there are many things that are unique to small caps. They are more fragile enterprises. They are smaller by definition. Therefore, we should expect higher returns. So we use a combination of balance sheet strength and sort of a real estate metric, cap rate, to price the stocks we want to buy. I'd say that would be used in any M&A transaction.
Right. But Chuck, you're less optimistic about a stock market recovery from August, right?
I am less optimistic.
But you're fully invested still.
We are fully invested.
Why?
That's our social contract with our investors. We essentially run fully invested, 0 to 15% cash in virtually all our portfolios.
Okay.
So our macro view, although it's interesting, isn't dominant in the stock picking.
Okay, but why are you less optimistic? Is it just because you've seen this volatility over the last 6 weeks?
I think we've created a real existential funk in this country around the subject of how do we solve our embedded problems. We all saw the civil discourse blow up in early August around the deficits and around the default change in the ratings. But unfortunately, there's no sign that that's changing. And I think that's a critical sort of overlay on this country that we need to deal with.
Chuck mentioned that the small cap stocks can move faster in either direction. Now this year, the Russell 2000, which gives you a gauge of how small caps are doing, is down 15%. That's double the S&P's decline. But since the March lows of 2009, the S&P is up something like 70%. The Russell 2000 is up 90%, excuse me, so about 20% better. So when you talk about your outlook now, the outperformance, let's assume the market recovers a little bit from where it is right now, from small caps compared to bigger companies would be about what, do you think?
I think you get a sort of leveraged effect in the small cap world. I do think in a rally, small caps will do better. They did worse on the downside this time. Not all times, but this time they did. I think we can definitely have a powerful rally here. We can have a 12, 15% rally like that. But that isn't really address, have the underlying issues been dealt with?
What are the underlying issues besides the debt and deficits here? We're talking about this idea that Washington needs to get its act together. You're not the first one who said it. But what needs to happen to make you a more bullish investor out of Washington, D.C.?
Well, we're going to continue investing. I totally believe that stocks are the better way towards dealing with inflation or deflation. So I think stocks still are the only game in town really in the long run. So we're not moving away from that idea. Small stocks give you a better play on anything going on, a better leverage play, a bigger opportunity set.
Right.
So we're going to continue doing that.
Well, we are back with legendary small cap investor Chuck Royce, also, of course, Dominic and John with me. And Chuck, you said something right before the break, which was that you believe that this market can rally 12 to 15% on a dime. Why is that? Is it just this volatility, or what exactly?
Well, it's largely the volatility, but just look at August. We had a run of almost that from the lows of August 8th to last weekend of August. In this era of 3% moves, that's 4 or 5 days.
Okay.
Now, as a mutual fund investor, though, you got to be wary about these volatile markets, because that kind of volatility is not something you expect out of a mutual fund. Do you find that that's an environment where people want to keep their money parked for a while, or do you think that those investors are out there kind of a little bit more agitated than
I think they're very agitated. I think it is not a healthy phenomenon to have this much day-to-day volatility. Now, you look at volatility on a little longer term, month to month, year to year, it isn't much higher than history. But on a day-to-day basis, we have gone off the charts in the last couple of years.
But in other words, are they leaving your funds?
We've had mild redemptions in the last 4 months. Small.
Okay.
And if you invest in a smaller cap company, one of the problems for investors is, you can get boatloads of research on any of the big companies, Apple or Goldman Sachs or whatever. With smaller companies, there's not as much. What's the one thing that you look for over everything else when you decide whether you're going to jump into a company or get out?
Balance sheet strength, the ability to survive the unknown. That is the key to investing in small stocks.
Chuck, we pulled out some of those holdings that you have. Ironically, some of them that we pulled out are retail. I know you say you don't focus, but Steve Madden, Ethan Allen, American Eagle Outfitters, some of those are your holdings. But you're saying you're not emphasizing consumer stocks though in your funds.
Right. We're not today buying a lot more of those. They would not be the high preference areas. Our areas today would be natural resources, technology, industrials, less consumer.
And why not banks?
I don't like banks. Banks are just too hard to deal with. They're too hard to deconstruct.
Even the smaller ones?
The smaller ones are a little easier, but not much. We have too many banks in this country, so we're going to have this form of consolidation. And I don't know that I could look anyone in the eye and say, my bank can sell at 3 times book, and I should buy it at 1 times book. So I think it's a tricky area, and it's an area we've avoided.
But you look at sector exposures right now. A lot of the sectors that you mentioned, industrials, energy, natural resources, are all cyclical in nature. I mean, they go up with the economy and they go down with the economy, yet you're choosing not to emphasize the consumer side of the equation. Is that some kind of a commentary about what the environment is like for the American consumer today versus what it's like for the economy overall?
Yes, it is. I think the consumer is continue to be pinched. And that needs to work out over many years. That's not a one-year phenomena. Industrials are benefiting, and so are many other sectors, by the gradual decline in the dollar. And although the dollar's been stronger in the last month or so, there's a long-term tendency for the dollar to go down.
And just a final comment on the technology companies. What is it you like about the smaller tech companies?
The balance sheets have improved enormously. These tech companies, mid-sized tech companies that have strong product profiles, have very strong balance sheets, and they, from time to time, have extremely strong, profit growth. And the markets have just ignored them. The markets have assumed that that we're never going to have a period of sustained growth.
Chuck, great to have you with us. Thanks for stopping by. Chuck
Thank you.
Royce of Royce Associates.